So investors as a whole ultimately look for signals regarding inflation predictions and priorities, employment focus, and financial stability and emphasis. My name is Shor Sardakis. I am an associate here at Vincent Hirsch Financial Services. There's been a lot of news circulating about what's going to happen with the next Fed chair, what's going to happen with the current sitting chair. Today we're going to provide some context around A, what the Federal Reserve is and what it does, and typically what the transition from current sitting chair to the next future chair ultimately looks like from a historic perspective. First, we'll address what it is that the Fed chair actually does. Now, the Fed chair is the person who serves as the leader and public communicator for the Federal Reserve, or the FOMC. The Federal Reserve Chair is the one who presides over the Federal Open Market Committee, or the FOMC, which is the body that's in charge of setting monetary policy, which is in charge of affecting interest rates, inflation rates. They look at job report data. They look at all of this data to ultimately decide what to do with monetary policy, which, again, is aiming to maximize employment and prices and find that equilibrium between inflation, interest rates, employment. It's very tricky and very hard rope to walk. It's important to understand that these monetary policies are made collectively, and it's not just the Federal Reserve Chair who is in charge of making these decisions. Federal Reserve is structured in such a way to provide stability and independence. It's an independent governing body, which again is headed by that Federal Reserve Chair. Leadership transitions from the current sitting chair to the chair nominee and what that looks like over the course of the period don't typically trigger any decisions, shifts, or monetary policy decisions. The new chair will ultimately inherit existing economic conditions, ongoing policy frameworks, and current inflation and labor data. They don't just clean slate everything. They kind of step into the shoes of the current chair, which is to help make that person's job a little bit easier so they're not starting from zero. There's also an early emphasis traditionally on maintaining that continuity and an understanding that monetary policy is to evolve gradually, and it's based on data ultimately. The key takeaway here is that there's an institutional acceptance and understanding that continuity tends to outweigh any kind of personality. The Fed chair has to make sure that transition is smooth. With all that being said, the Fed takes a look at economic data and makes policy decisions that influence and affect interest rates, unemployment, and inflation. So why do the markets ultimately pay attention? The markets react to expectation and communication from the Federal Reserve, and the tone and messaging can influence how the markets react and market sentiment. So investors as a whole ultimately look for signals regarding inflation predictions and priorities, employment focus, and financial stability and emphasis. And these adjustments and expectations happen over time based on the communications from the Fed. What this means for households is that Fed monetary policy affects interest rates, which ultimately affect our mortgage borrowing costs, credit cards, car loans, savings yields such as CDs or money market. The nomination for new Fed chair alone doesn't necessarily mean that we're going to have immediate actions taken. Typically, policy shifts are data dependent and they follow the economic trends that have been going on for the past quarter, month, whatever. This also remains consistent with the policy shifts being dependent on economic data and the interpretation of that data and the trends. When it comes to long-term planning for portfolios, for investors, etc., we've seen over the long term the smoothness of any kind of long-term returns. And in that vein, it's important to understand that context matters a lot more than urgency or short-term shifts. From a broader perspective, the Fed is more designed for gradualism, so that's just maintaining that data dependent policy over time. and understanding that we're in it for the long term, not just necessarily for short-term reactions. They understand that policy tools ultimately operate within long-standing frameworks, so this is a framework that's been designed over the course of decades, and leadership transitions are part of this institutional evolution, which again, we want to make sure is as smooth as possible, and we maintain that continuity from current to future Fed chairs. And then finally, economic forces are shaped by multiple variables and multiple people within this Federal Reserve Committee, this FOMC, not just the one person, not just the Fed chair. So with all of that being said, it's important to note that leadership changes are important, but they rarely turn into immediate policy decisions. Economic systems tend to move a bit more deliberately, again, because they have to focus on the data. And staying grounded in these long-term trends reduces overall reactive decisions when it comes to monetary policy. Now, again, this is just a informational. This video ultimately is to provide a little bit of context around what the Federal Reserve is, what it is that we've been hearing in the news the past couple of weeks, and how these leadership changes ultimately and historically have gone, and why it's so important that these transitions are smooth. So if you have any questions, please don't hesitate to give us a call or comment below, and we look forward to seeing you guys in the next video. Thanks.